Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, April 7th, 2025. Just want to get my thoughts out. I'll try to make it quick. I always say that, and then we do a 45, 50-minute video. But let me just throw out what I'm watching, my thoughts, which I've been doing my best to convey them in static posts, what I call static posts, where I write up and quick screenshot. But the videos, I just can convey a lot more thoughts, cover more charts. They're more efficient. Not much else to add, but I want to start out here with treasuries before I forget. I just shorted treasuries. This is TYX, the yield on the 30-year treasury bond. Remember, yields and bond prices move inversely one another. And so you have beautiful positive divergence. Yields have been dropping, obviously, for what I often talk about, a flight to safety bid. Institutions will sell stocks and buy treasuries when market volatility spikes up. And there's a lot of uncertainty. That's what we call a flight to safety bid. And then you also have rapidly declining economic growth expectations from the tariffs, which has caused this plunge in yields right down to really good support. I mean, this is a level I've had here on this chart. I created that line back in August of 2024. Very, very good support level right there. Positive divergence, everything I like to see. Not much else to add to that. I don't want to beat a dead horse. TLT, you do it in reverse. You get the bond price. And this is what you can short, either this or Treasury bond futures. I'm going to just kind of tweak that trend line. So that is what we call a divergent high or negative divergence right there. There's comparable resistance. Again, this is just going to be TYX upside down and negative divergence. And, you guys, I've been scrambling to get things out to you. I shorted this morning. I'm probably going to still add to it. I think there's more downside to come, but we're coming up as I do the video. And I went to do something real quick, sat down on my computer. I didn't realize how much we had reversed so far. I'm saying that almost a semi-apology, like maybe not the most objective entry now. Let me find ZB for you. Well, that's it. You can use ZB, which are Treasury bond futures. And I think you'll continue to see that. Yeah, obviously the VIX I threw out this morning, probably a short. And, again, let's get to the markets. Let's just start there. That's the easy to focus on that now. There's so much volatility there. If you want updates on any of the ancillary trades, or the additional trades, wheat, soybeans, natural gas, crude oil, gold, silver, all that other stuff I cover pretty regularly, let me know. Let's just stick with the equity market. So QQQ on the weekly chart, where are we at? Here's a weekly chart. I have different boards here. It's not a 10 on a scale of 1 to 10, but it's a pretty good, time to go long. As I've been saying for the last couple of days, what happens, the way my brain works is RR. I frame everything on a risk-reward perspective. Probability of success as well factors in, but those are two separately, not completely mutually exclusive things. In other words, I ramble when I do these videos. I look at every trade. Some of my trades have much better RRs or risk-reward profiles than others. The ones with the lower profiles, let's say a 2 to or 3 to 1 RR, usually have a higher probability of success. So there's two scales I look at. The probability of success on a trade. In other words, how likely do I think that trade is to play out? The higher the probability, usually the lower RRs. And then the higher RRs, meaning the trades that have much higher gain potential, especially compared to the downside risk. Those big monster trades, they tend to have lower probability of success, but then again, the favorable RR or an above average returns, if successful, offsets that, if that makes any sense to you. So that's kind of how I frame things. So what I say is that, as I mentioned this morning, and I haven't, mentioned almost on a daily basis for months, even when we were peaking here, I haven't waffled on my long-term targets, T2, T3. Now T3 was hit right there today, and pre-market got that out to you. And the most important thing is pre-market, don't read too much into Sunday night futures pre-market. That, I've said this for years. The starters step onto the field at 9:30 a.m., meaning, you got the bench warmer, second and third string players in pre-market and futures on Sunday night. Big institutions, mega institutions they're trading in such large blocks they can't move efficiently outside the regular trading session. So What happens in the regular trading session is more important than what happens in the after hours. Not to say in after hours you can't break a support or a resistance level, and it doesn't completely invalidate it, just that take what you see there with a grain of salt. So far, a big reversal off T3. So we were below it today. Now we're above it. So my third target's been hit. If you followed me for any period of time, you've heard me say, if not once, 1,000 times or more, what I call momentum-fueled overshoot, meaning when you're heading down with a lot of velocity or momentum to a target, it's more than common, especially if it's a vertical drop or a vertical rally into one of my price near vertical ascent. You will almost always overshoot it. It's that momentum-fueled overshoot thing I call, using the analogy of a pitcher throwing a fastball, hits catcher's glove, snaps back for a split second, and then springs back forward. And so that's what we have today. So effectively now a hit of my third target. We hit my first target here. We bounced. We had a tradable bounce. It was intra-week there. We hit my second target right here. That one right there. We bounced and went all the way to here. And now we just hit the third target. And again, I'm not looking for new highs this time. I wasn't looking for them then. They just happened to make a marginal new high. But that's it. So as I said, I'm looking to game a tradable bounce. Has to do with the oversold conditions. Has to do with the fact that, and I said it before, Trump, look, I don't want to get political because, you say one thing about one party, you say something about the other. Trump's a freaking idiot. I've always thought he was. I've always maintained that. But I tend to agree more on balance, believe me, not everything, but on balance more with his policies than his predecessor and who he was running against. So that's just kind of where I stand. But I am not, believe me, I'm far from a Trumpy. Now, and the man, what he's doing now and his old, he's put minions in place. You know what he does. He likes a bunch of yes men below him. And so whatever. They'll figure that out. They'll fix that. He benchmarks himself to the success of the stock market. Something will happen there. I know they're standing firm now. And if they don't, poor Powell, he doesn't want to cave and cow down. I'm going to imagine it'll come out in hindsight that there's been some closed doors talks where he was probably leaning on Powell hard to cut rates, and Powell refused to be political and probably hasn't talked about it. But if we go, here's what I'm saying, guys, be careful, stay nimble. If we go down, because all along when we were here, I repeatedly, if you go back to those videos, said it wouldn't surprise me if we because we already hit T1, T2, even though T3 was close and not hit and was the next target, I said it wouldn't surprise me to see us go down to T4. It still wouldn't, okay? This is just right now an intraday reversal. NASDAQ's gone green, so is the S&P, but we're not out of the woods yet. And nothing's been tweeted out as far as any kind of, change in the tariff policies. Last time Powell spoke, I think, was as recent as Friday when he said, no, we're not cutting. We're just watching the data. Guys, a couple predictions I've made repeatedly is that it would be the drop in the stock market that was priced into the charts that would be the cause for the recession that's coming up and still coming up. We haven't started that yet. But you've seen these bobbleheads on TV pull 180s, and they're really, I got to change my outlook now because the stock market's plummeting and these tariffs are going to... Again, it all comes in. One day, if you do this long enough, you'll understand. If you read the charts right, the charts will dictate where things are going to go, and then the fundamentals will align. They'll either retrofit or fit a headline on as the cause for a drop, or they're together. They're not separate. They're two correlated things. And anyways, when the technicals play out, sometimes it's a fundamental catalyst that then triggers the technical drop. In this case, it was the technical breakdown that triggered the, fundamental. And you could, obviously, I know there's some that will say, this is just 100% due to what Trump did. Again, I think we've seen enough of how things have played out, the precise breakdowns, that kind of all-in moment, when support broke the minutes after Trump announced his tariffs. And there we are. So, again, I've said this repeatedly too, especially if you're new to the site, if your trading strategy is to trade off news headlines, if you're waiting for Trump to tweet out that they've made some progress on the tariff fronts, or if you're waiting for Powell to come out or a Fed governor, or to say that they're going to cut rates soon, or they're going to do an intermediate rate cut or something along the lines. I can all but promise you, by the time you wait and read that headline hits, you're going to have missed most of the move. And at that time, it's almost going to be time to short in for the next leg down. So again, it's got to be quick. And I've said this too, if this is not your cup of tea, if you are not experienced in active trading and reversing quick, pulling the plug on positions when you're trying to game a bounce or a drop, you're going to get chopped up, chewed up, and spit out in this market. So, paper trade it, watch and learn, go to cash. That's the other thing. I get calls always when this stuff happens. Oh, Randy, what do I do? My 401k, friends, people that I know that what I do, if I'm right, let's just, for a minute, let's just go with that. We're going down here. And again, this is just leg one down in a much bigger bear market. We're not going to go, I can all but promise you, we're not going to go from point A right here at the highs down to my final target, which is a 55% drop in the NASDAQ 100. We're going to zigzag down. It's going to take time. We could be there by the end of this year because stocks tend to fall faster than they rise. So it could be a 2025 target or 2026. But there'll be plenty of bounces along the way. And what I say is, and I even had a call from someone yesterday, what do I do with my 401k? What do I make money in? Cash. There's no 401ks don't give you shorting options. They usually don't give you commodities and things like that. They're usually stocks, bonds, cash. Stocks being U.S., and within the U.S. arena, you have small, mid, large, you have value and growth, then you have international stocks, then you have the bond arena, which is usually government and high-quality corporate bonds, and then money markets. And I always say there's, in a bear market, yeah, you're not going to make much on a money market, and rates are they will come back down. If this is right, we'll see rate cuts. We'll go back down, lower rates. You're not going to earn much on the money market funds. But it's better than losing. People always are getting that mindset, I have to make money, I have to make money. If you're not an adept, skilled short seller, you're not going to make money in a bear market. You're going to lose a lot of money. And so why not just put it in a money market, make a little interest, and not lose? You're actually getting ahead of the rest of the world. It's technically deflationary. If the stock market drops 50% and everybody around you, your neighbors, your coworkers, everyone just most people lose half their net worth or, a good part of it, then you're ahead because now demand has come down. Their discretionary, not their discretionary income, but a lot of their discretionary spending. We all know, you've seen the fancy cars on the road. If you live, anywhere like Southwest Florida, go out in the river, I see these boats. They're $2 million center console boats with 5 Merc 400, 500 racing engines. Each engine's almost $100,000. It's crazy the amount of money that's been sloshing around. It's reminiscent, I've said it for a while, like 1929, the Roaring '20s. The amount of just wealth that's been created by the Fed bubble they've created for, with zero rate, excessive stimulus for years, even when the economy was strong, keeping the pedal to the metal with both fiscal and monetary stimulus. So there'll be a reckoning. And then where I'm going with that is, if you wipe that out, you're wiping out where most discretionary spending was coming from. In my opinion, was more so for probably maybe not the first time in history, but the first time in a while. This is just me. I don't know if anybody said this it's been written or spoken. A lot of that discretionary spending has come from the stock market. I know that just from knowing people I know. They're spending because their Nvidia went through the roof and Bitcoin and all that other crap. And therefore, when that comes back down, that's going to put the brakes on things. We all know the upper echelon does most of the consumer spending, especially discretionary. I'm talking about where 80% of the wealth in the market's concentrated in the top tier. So when that goes down, spending will drastically slow, which then creates it helps offset the effects of inflation we have. It's deflationary, whether we're going to get deflation or just less inflation. I know the word stagflation is still buzzing around. Again, the takeaway here is you don't know what to do. Just duck your head in the sand, put your money in a money market. You lose nothing. You make a little interest, and if I'm right, and we're going from point A ultimately down here to point B, there'll be tremendous buying opportunities. You'll get to buy Apple and Nvidia. You know, my target on Nvidia hasn't changed. If you're new to the site, I laid those out last year. Gave you this is my fourth and final target. These are calling for a 72% drop on Nvidia, and I've continually updated these targets. I haven't changed, waffled. The only difference when I first laid that target out, that was back in June of last year, right here, June, we made a ever so slightly marginal new high, but since then we broke major sell signal when we broke the primary bull market uptrend line, then the big bearish engulfing candle at the high with a divergent high. I literally don't believe I could have more technical evidence to have gotten long-term bearish and shorted Nvidia than all that occurred there. You know, that you can't. I've never seen more high probability sell signals on a single stock, or you know, and again, like I've said all along, the most important stock, more important than Apple, even though it was typically smaller than Apple, it was a psychological importance. This is the poster child of the AI bubble. Everybody knows that. That's not it's not debatable. It's not my opinion. It's fact. And so when that dies, the bubble that's taken the market to the levels that it has dies, right? So I always said, kill the general, you win the war right there. You just, you know, the 5-star general's been taken out. But the thing is, we've only started. We're only between my first and second price targets. So if we don't get a tradable bounce now, you can see this one is kind of in no man's land. We've taken out, remember, we hit my first target back here shortly after I laid it out. And again, it's not like we went underwater there. We reversed and covered with impunity at the lows the morning of August 5th. This particular trade and others, for reasons, it hit the trend line in the 200-day moving average, and we actually went long that bounce there. So if you look at the percentage gains, just like that VIX trade, it's much more than that if you've been trend trading this stock, swinger trend trading it. And again, I'm not sold on a bounce right now. It is far from a 10 on a 1 to 10. The bounce right now, it's reflexive. We're oversold, but I've always said oversold, and we're not even oversold in the video. I'm talking about the stock market. Oversold is a condition, not a buy signal, so be careful. Let me just move this in. I just wanted to, again, look at this chart because this is an important one. We'll look at all of them real quick, go through Apple. These are just longer term charts here. Apple weekly. You know, each of these are support levels. And, you know, my long-term target, I still think we're coming to this yellow uptrend line. I have different boards on Apple. There's another board right there. I'm just kind of going through the levels, showing you Microsoft, the arrows that I've had for a long time, have it coming down here. So Microsoft, before all said and done, will probably drop 57%, which is right in line with my QQQ target. So that's it, guys. We're en route, and it's how bear markets. This one certainly has started out with a bang so far. And again, more downside to come. But as I said this morning, it's all about the risk reward. If you didn't want to short here when Amazon broke that beautiful bearish rising wedge on the weekly cleanup trend line, or when it fell back below the trading range there, those two powerful long-term sell signals. And again, this isn't a 5 or a 15-minute chart or even a 60-minute chart or even a daily. This is a weekly chart and all these levels. So that was the in, that was the short. Then you had opportunities to short the back test of the 200s when we went through it. Then when this support level is taken out. Now the thing is, this level's taken out. So we have quite a bit of resistance. So this bounce is, so far they've reversed it a little bit. They've sold into it. Actually, we just went negative. So market's moving so fast as I started the video. So I'm just kind of giving you the big picture here. And the near-term picture, it's going to be super fast, super volatile. Oh, let's talk about, well, let me cover a few more here. Again, we're just on the weekly time frame. Alphabet's at really nice support right here. But again, just some beautiful sell signals on a lot of these stocks recently. 200's taken out. So by every metric and technical analysis, we had multiple long-term sell signals. And as I said, the thing about short selling is the market moves fast. You can't sit and wait Kramer tells you it's time to start selling or shorting stocks, because he'll tell you. I don't watch Kramer when he comes on. If I have to turn on CNBC to watch anything, I'm sorry. I have to mute it. I just something about anyway. I'm speaking just generically. But you can see now that Alphabet's come up on support. So does it go, before a meaningful bounce down to this trend line that I have here? Yeah, very well. And I'll be singing the same song I'm singing now. We're oversold, the odds for a bounce, especially, again, not on the weekly, guys. Oh, yeah, we are. We just hit oversold on the weekly. I was zoomed out a little bit. You can see down here at the bottom where my crosshairs are. We also, interestingly enough, see, and okay, and I said this a few weeks, I've said this multiple times going back at the highs, trying to really impress my convictions that the market, I even said if we broke to that new highs, it wouldn't be a new high that I would chase. It would be a new high that I would bet on failing. And that's what happened with the markets. And then one thing I promise is that the sentiment will change on a dime when the markets break down. All of a sudden, all those crying, no recession 2025, we're good, the market's going to go higher. Tom Lee coming out just about 2-3 weeks ago, he's America's favorite perma bull right now, calling for a quote-unquote rip your face off rally to take the markets to new high. Well, he got his face ripped off, but in the wrong way. And I'm not trying to pick on Tom Lee. I'm just trying to talk how these, the analysts will change on a dime. I don't know if he's just gone quiet or if he's still going for that rally. But anything can happen. Let me just show you something here. The one thing I guarantee, there'll be some resolve with the trade wars. There'll also be rate cuts coming up now, a lot quicker than we're priced in before. I haven't looked at the Fed fund futures. I don't need to. I can, in my head, I know where I can just tell you that the Fed fund, the chance of a rate cut has gone up drastically in the last week, right? That's just, you can check the futures. I don't even care where the Fed fund futures are. Now, unless we bounce quickly and we get some strong economic data. But I want to show you here, this is Alphabet. See this PPO? You look at the 9 EMA. That's the last of the two to cross. This is known as a signal line. It does a great job on a lot of stocks as defining the trend, meaning when you're above the line, the zero line, which is the dotted line I just covered there. I actually have it at negative 0.031. I put my own lines if that's where the PPO signal line is still there. And if this stock turns up, it's going to keep this longer term. This is what we call this is the primary, longest term. The primary secular trend is bullish. This is your intermediate trend that was bearish there, bullish there. And this is your short trend. The intermediate trend is still bullish right now. The short-term trend is bearish, right? This trend indicator here, it delineates bull and bear markets. Now, if it crosses down, you're going to flip. Last time it flipped to bearish was right here, and it told you were in a bear trend, intermediate term. Then it went back to bullish, so it'd get long and strong. Again, if you're only using this indicator. I don't use it standalone. But what happens is that zero line, or in this case, negative 0.31, tends to delineate bull and bear trends, but also acts as support when above. On pullbacks to it, you often bounce and keep the trend intact. That's when you want to buy pullbacks, right? And you can see a couple brief whipsaws, but other than that, it's done a pretty good job. So if things change, if the headlines change, if the Fed cuts rates, if the trade wars are resolved, I don't see any quick resolution. Trump has too big an ego to just completely eat crow. I don't know if he'll run the country into the ground on this or not. I don't know what'll happen there. I understand that Congress can actually take back and override that and block his the maneuvers he's made, but they said as of last week the Republicans are unlikely to do that. So just stay flexible, guys. That's all. Right now, the intermediate term trend is clearly bearish with no evidence of a reversal. But we are getting quite oversold on both the markets and a lot of things. Some things have more downside to come to my next targets, like Meta, not oversold, not to weekly support there. Tesla just hit my 5th price target here. These targets were laid out back here. We hit T1, T2, T3 zone, T4, T5, and a lot of things are shaping up with divergence again. But I told you, divergence, especially on the intraday charts, But even sometimes on the daily charts can get snowplowed in a bear market. What do I mean by snowplowed? Just taken through. We go right through them, and then you no longer have the divergence. But what you have to respect is if you do get it, especially divergence at support, those are likely or potential reversal points. What do you look for? Well, if you want to play it safe and you don't want to step in and catch a falling knife, look for bullish reversal candlestick patterns and high volume. You look for a selling climax. Let's see what QQQ looks like now. I know we have the potential for a selling climax. Friday's volume was huge. You can see the volume bars down here. Here's what I'm talking about. Let me turn off all the lines. This is QQQ. There's your volume bar. Remember, today's volume bar is in progress, and it's big so far. So a selling climax, and it's funny. This is my very first exposure. What kind of triggered my passion, my freaking obsession for technical analysis. I was a rookie broker at Merrill Lynch. This is in the mid '90s, like 1995, I believe. One of our regional managers had come into the local office I was working in, and he gave a presentation covering technical analysis. Up until then, Merrill had the best course at the time in the industry for their brokers, extensive training course, but it was I would say 50% at best fundamental analysis, economics, everything I knew. I'd come out, was a business major, but even more in depth, fundamental analysis, economics and reading balance sheets and all that. And then the other 50% was sales. I'll be honest with you, was, working there. That was back in the days of the movie Boiler Room, and that's what we were doing. We were hitting the phones as rookies and cold calling, and just with a fancier moniker to say you're calling from. Anywho, all right, where I'm going is this was, I clearly remember when his name was Guy McDonald, and he came in and he told us that he taught us about selling and buying climaxes, and really, obviously, Merrill Lynch are really mostly talking about selling climaxes because when you work for a broker, any brokerage firm, you're going to be brainwashed. The stock market always goes up, and it does 90% of the time. You're going to be fine if you have a long-term time horizon, riding out bear markets, buying dips, because the stocks do go up much more than they fall. But then, so we were being coached on what to look for in corrections in a buying climax. I remember being one of them, and that is you see stocks going down, and where does it stop? You never know, right? But you can tell by looking at volume. And what you see is when you start to see a surge, as prices start to waterfall at the end, that very last impulsive drop, and all of a sudden volume just spikes up. Then especially you can see it in hindsight. Once you start to go up, volume drops off. That is a selling climax, just like a buying climax in reverse. We didn't have a buying climax here. That was a double top. You don't always get a buying and selling climax, but when you do, you want to look for it. And so far, we're going to see today's volume is going to be big. And we could be down again. And then tomorrow could be even bigger. And we could be down again. So try to look at this, especially if you get a reversal stick. And follow up. And again, there's a saying, second mouse gets the cheese. So if you want to be second mouse, wait. Even though we have the potential of a selling climax here, I think it would be a near term, just for a bear market rally, not a move to new highs. But again, a bear market rally, where to? Shoot, I could easily see us doing 15%, 20%, about 15%. I don't think we'd go much past that area there. And we can go another 5% lower. So let's see where we can go before that starts. Well, let's just go to my weekly chart. So far we hit T3. We're there right now. We're at 416.23. I have that level at 413. It says 412.99. I'm not going to change it. I should have rounded that because I've created that line back all the way back on June 26th. And so that's still the third target. And we're there now. We're a hair above it. And if we don't hold here, we go to T4, and T4 all along back here, I was saying that it wouldn't surprise me to see us go down through T3 with little to no reaction, hit T4, only because we already came so close to it when we hit T2. And based on also the bearish nature of the everything that formed, these divergences got so big So I started to get more bearish than I was back here once the turn came. So there it is. Now, do you hold out for that level if you want to go long? No. I think if you're trying to game a balance, you start scaling in today down to here. You could right now. VIX, I gave you my clear thoughts on that. Just like when it's all about RR. Now look, and I said in there, as I often do when I update trades, when targets hit, here's what you do: stick to your trading plan. If your trading plan was, you know what, you took it here when I first laid it out, you took the breakout, or you took, you bought in, you missed the whole thing, but then you started to believe when we hit T1 and you bought here on my scale back in zone, right? And your trading plan was to hold, just tuck it away and hold out to T3, stick with your trading plan. But at this point, raise stops. Don't let it get away from you. If that was your last buy point, well, you can put a tight stop. You can have a wider stop. The thing about stops is the wider the stop, the more you're going to lose on a reversal, but the better chance you have of getting that stop clipped on a little pullback if you are going to that target. So all I can tell you is stick with your trading plan. I can also say that, upon the initial tag of each target, a reaction is likely, just like you had when my first target was hit. I still think that's the case. I still think, and personally shorted the VIX today because we're probably going to pull back. That's the T1 target was 78.30. We hit it in pre-market, and then we hit it in the regular session. If you missed it, if you didn't get that post this morning, and now we're below it. So now, if we power on up and the market takes out today's lows and starts to move a lot lower, and we take out this high in the VIX, yeah, we could spike up there. Remember, the VIX, when she wants to run, she can really run, and she makes overbought look like it can just go right through overbought. There was the last time the VIX spiked, and things weren't even nearly as bad then, guys. That's 2024. Look how high the VIX went. This has a 15-minute delay. I have other live charts. Here, I'll read it for you. Off another one. VIX right now is at 51.64, so we're right about where my cross. Yeah, right about there still. And then you can see what happened back then in 2020 when COVID hit. And then you look at my weekly charts. However, here's a nice one. This is important, guys. Haven't touched these levels in forever, right? Text created back on 2022. If I updated, I probably dragged it. So this is my long-term chart, my weekly chart. This is where previous bear markets ended back in the aughts, the 90s and early aughts, late 90s, early aughts. This is where bear markets ended since that period. That was the financial crisis. That was COVID. Those were the two real bear markets, in my opinion. This one here wasn't for many metrics. I told you I don't care about the old antiquated 20% drop definition. I told you then I thought that was just the first leg down of this bear market that we're in now, and just had a marginal new high. That's all. And that's, but again, the important thing is since 09 to 2021, this is where corrections ended. Boom, 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 boom. Well, that certainly ended. It also was a bear market, but it ended right after that. And then boom, that last one spike into that level back then in 2024. And then boom, here we are again. So it's resistance. Now, if we take that out, we go here anytime soon, I do not think it's going to end this bear market. I don't think this bear market ends till we hit my 7th target. That's what I'm maintaining now. But I promise you, I am flexible. I am not married to any one thing. I made a comment in the comment section today after one of the posts. Somebody asked my long-term outlook on the market. I shared it. I think it's going to be a prolonged, very, very different bear market than most people can imagine and foresee, but it's going to be a great one because it'll be similar to look at the Nikkei. Google searched Japan's lost decade, which was really 2 lost decades. And you'll look at the period from, pretty much 1990 through, until recently, where the Nikkei had 2 years of, a massive big bear market, 2 decades, I'm sorry. But there were powerful, very profitable bull markets to trade. So what I'm looking at upcoming is a secular bear market that's going to be multi-year, probably 6 to 10 years or more, but with powerful, even some long-lasting, very convincing bull markets. I don't care. Those are semantics, bull, bear. And what I said is I don't position for where I think the market's going to be in 10 years from now. I'm positioning where, depending on which account I'm trading, whether my active trading account or my longer-term IRAs and those accounts, I'm positioning for where I think that we're going to be anywhere from a few hours to a couple in the next few days to a few weeks or a few months. Okay, so those longer term accounts, they're the ones I don't actively trade. I hold out for my longer term targets. I don't try to game every little counter trend bounce on the intraday charts. And so, again, if we go 5 years from now and the stock market's, at new highs and this was just a buying opportunity, then I'm not going to have been positioned against that, if that makes any sense. So again, so what I'm doing, I'm showing you here, we're at a pretty good resistance level on the VIX. But again, the VIX, until it reverses, it tends to go. And the one thing it does too, the VIX tends to peak before the stock market bottoms. So let's keep a close eye. I will keep a close eye on the VIX and see if we can get some decent evidence of a reversal via candlestick patterns. So far, it peaked after the open today. And so again, we're very oversold on the equity markets. Oversold's not a buy signal, but it just says, hey, if you missed this, if you missed shorting the market, you probably, in my opinion, I would personally, had I missed it, I would just wait for the next objective reload. I'd rather short at this point on a bounce back to resistance when I think that bounce has run its course, or what I'll typically do in volatile markets like this, even with swing and trend positions, scale in. You start, if you want to buy a shorter rally back into resistance, I have a zone, a target zone. I'll short a third here, a third here, a third here. I'll just keep shorting up to, but not above where I think it's going to bounce. And I've covered those levels a lot lately. Same thing on the way down. It's time to start covering shorts when you start approaching the long-term targets and reducing or when you're in free fall, what you can do too is just trail stops down, keep trailing them down. Yeah, I'm still talking. All right, guys, I'm gonna shut up and get the video out to you. TLT, we got a little reprieve bounce, so that one might be certainly a little more objective now. Like I said, I started the video with that one. There's support, which it almost hit but didn't quite hit. And again, the case that I laid out in the beginning of the video was based on the daily charts. I duplicated. So what might, just it's for kicks and giggles, what might cause, because what I could see is the next sell signal will come. See this uptrend line right here? And this price support, when we break that price support, I'm going to set an alert right now. 89.71, set an alert. I suspect that'll break and TLT take the next leg down. And that'll be one of two things could cause that from a fundamental perspective. Now, from a technical perspective, it just has to happen and it doesn't matter why. The why doesn't matter. But let me give you the why. Two scenarios. Number one, the stock market rallies, Trump and China and everybody starts singing Kumbaya on the trade wars, holding hands, and we've got to figure it out. Market loves that, rallies. Or the Fed comes in with the heavy guns. It's 50 basis point intermediate rate cut or whatever they do. It's just whatever. Those are fundamental catalysts that would cause the stock market to rally and therefore yields to go up or selling of treasuries. A move out of the flight to safety bid is where I'm going with that one. I'm sorry. The other thing would be economic expectation or the selling of the treasury bonds not based on economic expectations have plunged. That's why bonds went up, yields went down, in anticipation of slowing economic growth, plus the flight to safety bid. That's what caused bonds to go up here in all this, really. Now, there is also the thing that the U.S. is not making any friends. Trump's pissed off everybody, even our most ardent allies. He's insulted everybody. He insults Canada. He insults Denmark. We'll take Greenland. It should be ours, and we need it. And he threw tariffs on some of our most powerful allies in Europe. And so where I'm going is just maybe a move away from the dollar, move away from treasuries, some selling of treasuries by other countries. So that would cause also a drop in treasury bonds there and yields to rise. So it doesn't matter. Again, the technical case was made. Take it, don't take it. It's one of many trades. I just want to share it that way and give you both my technical insight, which first and foremost is why I shorted treasuries, and then the potential fundamentals. And you can look for those. Those are just guesses of things that may happen, but if they do happen, then that will help to confirm from a fundamental perspective as to why you may want to be short, not long treasury bonds. I'm going to wrap it up here, get the video out to you guys. And I will follow up with more specific bounce targets should we get decent evidence that a rally's going on. One thing you look for, traders are going to look for, let's turn off all the lines real quick. Gaps. Gaps are a magnet. Traders love gaps. Tops and bottoms act as resistance levels. So you got a gap there, you got a gap there, and you've got a lot of support there. This is where you had one little check dip below there, a little failed recovery attempt, then the bottom started falling out. So this is as of this point in time. This could change. That's my maximum bounce target. You can also draw a downtrend line off the highs potentially and something like that, and that comes in together. So we're talking, from today's lows, anywhere from a bounce of about 9 up to about 15, 16%. And let's see how we close the day. If we close the day on or above where we're at right now, we're going to have hit and held my third price target on QQQ. And remember, I gave you back then price targets on SPY as well. Gave you this target T3 back on same time, late June, at the end of June 2024. We hit my first target. And again, we covered there. That was the August 5th lows. We covered with near impunity after being short the highs. And even better than it looks here, because we covered in the pre-market session when we were below that, right on the 200s, and reversed everything there. And so that's just the typical reaction off T1 hit. And again, you see the candle going underneath. So we even got better than that because that's where we reversed, not on T1. And we just went through T2 and kissed T3 this morning at the lows, especially in pre-market. I think it was a perfect hit. Let me turn it on. Maybe even a slight undercut. But there it is. You can see the candlestick right on T3. So that's it. And we never had a reaction on T2. So we could get one off T3. It would be nice. And if we go any lower, then we have T4 just below, just like QQQ. So again, guys, the RSI is buried. Indicators are buried. There's no reason to, right now, the market's rallying just because it's so damn oversold. And it's rallying what I know. It either breaks, the financial system will break. I have all the confidence in the world that something's going to have to come in. We either crash and then we're all screwed. The country's screwed. Banks will break. I watch that. Trust me, I'm watching the financials like I told you. I'm looking for any cracks, broker dealers, banks, regional banks, non-bank financial companies. And the Fed knows this. I have to imagine that Trump has at least some smart people around him in saying that if you continue to play chicken with the markets, you will break something that is potentially irrevocable. Again, a huge fund or financial institution, then you're going to be bailing them out. So I think the market's rallying now, and what I know, we're going to see a headline this week. Something's going to happen most likely, and if it doesn't, then boom, take this. If I get this tradable bounce up to where I want, and I see some resistance levels, and I don't see any good headlines coming through. Oh, by the way, there's a nice bounce target here. I'll turn the levels back on here for SPY. Sorry, I was trying to. I'll draw it in for you right here. You can see right there. It's really nice support on SPY, and that would be a bounce of about 11.5%. So there's kind of an optimal bounce target range, guys, if you want to play the bounce. And then as far as VIX, I know I'm still talking, aren't I? I told you on the VIX, if you reversed it as well and you want a game of pullback, it's as much the charts of the VIX as it is the stock market. In other words, I'll cover that VIX short when I think it's time to start covering the index longs. Does that make sense, right? And probably like the index longs, it'll be more of a scale out of longs, scale back into shorts thing, like I've been, doing on the downside. That's what I'll do in these fast moving markets. All right, guys, let me wrap it up here, get the video out to you guys. And as always, if you have any questions, fire them off in the comments section. I'll do my best to get back to you ASAP. This has been Randy Finney with Right Side of the Chart. Have a great day.